Now, Donald Trump's one big and beautiful bill recently just got passed and signed off. And I believe that there are a lot of major changes in this bill, and it will affect the business models, the economy, and the consumer spending models, and pretty much every aspect of the economy in the US. And there are also a lot of questions and doubt regarding to what is this bill anyways, and what are the impacts to the consumers, specifically real estate buyers and sellers and investors. And what about the real estate market going forward as a result of this bill changes? And that's what I like to talk about in today's video. And first, let me start with sharing with you what are all the changes that I have seen pass in this bill. So these are the 13 items that I have taken from all the news source, and I have compiled this list. And I'm not going to go over every item. I'm only going to emphasize on the real estate topic. And therefore, I'm only going to be talking about mainly these four items that I highlighted in bold. The rest of the items, you guys can read about it from the Congress website, which I have included a link at the bottom of this page. But these four changes are what I believe are going to affect the real estate consumers' behavior, investors' behavior, and directly or indirectly have effect on the real estate market. So let's first start with these two items, the SALT deduction cap and the standard deduction, and what that means. So in order to understand how it would apply, you as a taxpayer first needs to understand the itemized deduction and standard deduction. I'm pretty sure as tax filers, we've all encountered something like that. And if you are a single or married W-2 income earner with no assets, most likely you're going to go with standard deduction. But if you are a taxpayer who also owns real estate assets, then you're probably familiar with itemized deduction. So what that means is that let's take a look at the itemized deduction group. Typically, it's going to include something like a state income tax and property tax, which is in real estate. So if you're a homeowner or if you're planning to buy a home soon, then you're going to have that. And then a local tax, and then sales tax if you choose to go with that instead of the state income tax. So what the SALT deduction changes from the big beautiful bill is that before the OBBB, the limit was $10,000. That's the limit that you can apply. And then after the OBBB, the limit has increased to $40,000. So what does that all mean to real estate buyers or someone that has owned a home but are paying high property tax? So let me show you in the next example. So let's take a look at this. So let's say before the one big beautiful bill, a person with $200,000 income, which is pretty common in the Bay Area where I'm at, and this person is buying a $1.5 million home, or this person is already owning a $1.5 million home. Let's say this person's state income is roughly $15,000. This is California, and again, this is just an estimate. And let's say property tax is $18,000. So this person's total expenses in this will be $33,000. But when this person applied for itemized deduction before the big beautiful bill, the deduction that was allowed was only $10,000. So what that means is that take this person's $200,000 income and deduct $10,000, this person will still have $190,000 taxable income. So now, with the changes after the beautiful the tax bill, this person with the same situation, and this person now can deduct up to $40,000. And in this case, this person can deduct all $33,000. So that makes this person's taxable income decreased from $190,000 to $167,000, which basically means that this person is saving a lot of money in taxes just by having these regulations alone. So that's that. Now let's talk about these two items that are going to be huge beneficial to the real estate investors and just business owners in general. So the first one is 100% bonus depreciation return, and the second one is 20% QBI deduction made permanent. So the first one, the key here is full first year depreciation for qualifying business assets and real estate. And the effect is basically the next 3 years. What does this all means? So let me explain. Let's say me as a business owner, and let's say I am buying a new car, and this car is going to be for business use only. It's a commercial vehicle. So this will be considered as a qualifying business asset. And it allows me to do a full first year depreciation, which means, let's say, this equipment, this asset cost me $50,000, and I basically get to write off the entire $50,000 against my income instead of versus before the OBBB, and by 2025 it would have been only 40%. So that's a big difference. And in real estate, however, a lot of people are going to think, oh, really? So what if I buy an investment property? Because I am basically a professional landlord. I am in the landlord business. So what if I buy an investment property for $1 million, Bay Area's typical price? Do I get to write off the entire $1 million against my income of that year? That's not true. That's going to be a misunderstanding. So for the specific cases of real estate, if you want to know how much you can write off applying this bonus appreciation, you need to do something what we call cost segregation first. So let me show you how that works. So for cost segregation, let's say I just bought $1 million home. This is going to be a rental property. And in real estate, when it comes to cost segregation in the eyes of IRS, there are basically three different components. The first one is the land value, which in the eyes of IRS, there is no depreciation. So in this case, let's say $250,000 estimated value goes towards that, no depreciation. And the second would be the structure of the building. This includes the foundation, the walls, and all these other things. And they basically have a longer life, and therefore they would depreciate over for 27.5 years for residential properties. And in this case, let's say $500,000 in estimated value. And then there are what we call the short life assets. And these are going to be the plumbings, electricals, floors, appliances, cabinets. And this is where you can apply bonus depreciation of 100% value for the first year. And this, in estimate, in this case, let's say it's another $250,000. And in this case, what that means is that 100% bonus appreciation allows you to write off $250,000 total in year one. And the condition is you make the purchase, and then the asset has to be put in service of the same year of the depreciation rules. So in this case, if you buy a home and then it's ready to be rented out in 2025, and then you literally, let's say this property gives you an estimate of $250,000 of short life assets, then you can literally take that and apply it against your total incomes and use it as a write-off. So this is going to be huge when you compound this with additional 20% additional QBI if you are managing your property through S Corp or LLC. That will really help you understand the benefit of this for high income investors and help you put in perspective. Let's say a rich doctor who's making between $500,000 to $1 million a year in incomes from his practice. And let's say he buys a rental property, $1 million somewhere here in the Bay Area, and he could literally write off $250,000 the short life assets using the 100% bonus depreciation against his $500,000 incomes. And this is going to be a huge tax shelter for high income, high net worth individuals. And for this doctor, he could literally be buying one property per year if he wants to continue using it as a tax shelter to continue writing off against his high incomes. And let's say a few years later, let's say 5, 6 years later, he does not want to continue buying homes. What he could then do is sell one of his existing property that he bought earlier and do a 1031 exchange and buy a new property and again apply the 100% bonus depreciation. So with this rule in place, real estate becomes a huge tax shelter for high income individuals. And a lot of these high net worth individuals probably own stocks, cryptos and other things. But nothing provides tax shelter the same way as real estate. So you could literally be seeing a lot more rich, high income investors be buying real estate almost every year and using it as a tax write-off. So as you can see, this One Big Beautiful Bill Act does create a lot of incentives and benefits for home ownerships. And does that mean that the buyer demands will be created again and causes the real estate market to go up? Well, in the short term, it is hard to say because, in my opinion, the real estate market is still mostly dependent on the overall economy, the job market, and other things such as inflation and etc., which in the short term, it is still full of uncertainties and hard to predict. However, in the long term, a lot of these bills, incentives, does create a foundation for long-term real estate market boom. Now, one disclaimer I have to make. I am making this video just to share with you the information about this One Big Beautiful Bill Act and my understanding of it. It is by no means giving you any sort of legal advice in taxes or investments. I'm just a local real estate agent here in the Bay Area. So if you're looking to buy or sell real estate here and have questions, feel free to contact me and I'd be happy to answer questions. But other than that, if you have tax problems, or investment questions, definitely check with licensed professionals. All right, if you like this type of video, definitely hit that like and subscribe button, and I'll see you on the next one.